Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. And guys, we have a very special guest on today. I'm so excited about unpacking this because he's going to be bringing the heat today. He's a senior wealth advisor at Carson Wealth, a nationwide financial planning firm that specializes in helping individuals, families, and business owners, which is where we're going to be diving into specifically, plan wisely for the future. He has 17 years of experience in finance and enjoys working with clients to align their personal goals with their investment strategy. We're going to be talking about the M&A, the exit strategies, what you need to be thinking about, how you need to be thinking about it, what's that process look like, and having the right alignment and making sure that you're going to exit properly. What do you do with the money once you obviously deploy and have some really good stuff? He has been a certified financial planner since 2011, and we are so excited about having him on. Please welcome my next guest, the partner and wealth advisor at Carson Wealth, the one and only Chris Graw. How you doing today, Chris?
I'm doing great. Thanks, Christian, for the kind words and introduction. That's awesome.
Well, Chris, I
Happy to
really
be
look
here.
forward to having this conversation because obviously, like I mentioned, you guys have been very, very prevalent in the RIA space, and you guys have done very well with specifically a lot of family offices, a lot of wealthy families, as well as business owners. But before we dive into all that fun stuff and the M&A, I want to get a little bit about your background, Chris. What drove you to the financial world? What was that passion? You've been in it for coming on to 20 years overall in this industry. What was your drive, man?
Yeah, well, to be real candid and honest, it was a little bit of dumb luck and running into the right people at the right time. So I graduated from the University of Iowa Business School of College of Tippy back in 2003. And so, that would have been kind of post 9/11, post tech bubble, if you can think of the business environment at that time. And, the job offers I was really getting was basically to pick up a phone and answer annuity phone calls and sit in a cube all day. And I just was not interested in that. And so I found an internship at a life insurance company, which is where I started, kind of cut my teeth on insurance, and then got into financial planning and investment management and all that stuff later on in my career. So thankfully, I had a wife who was a nurse and actually made pretty good income and was able to support us as I was doing my business venture for the first 3 years or so. And we just lived really frugal and kind of made it happen. And I think a lot of times, in business or in life, it's hanging in there and surviving to be able to thrive later. And so I just am so fortunate I was able to do that. And like I said earlier, met some right people at the right time, whether that be mentors or clients or whatever, and was able to just make it to the next day. And so that was kind of the start to my career back in 2003.
Well, in 2003, you obviously, that was pre-2008, 2009 crash, of course, and so there was that up to the right trajectory.
Mm-hmm.
You're going with that. But then during that 2008, 2009, you obviously still stayed in it, and then you were wealth manager at Northwestern until 2020, and then obviously now you're a partner at Carson Wealth. And during that time, though, when you were as a wealth manager, how did you navigate that? Or I should say really not how you navigated, but what were some of the lessons you learned during the downturn that helped you become the, obviously, Chris that you are now in regards to the clients that you're working with at Carson Wealth?
Yeah, that's a great question. I almost feel like, for some of the older clients we work with, or especially their parents, would tell them stories about the Great Depression and things like this. And, up until 2008, I really hadn't had that event that really solidified certain lessons in finance that you kind of adhere to or principles that you adhere to. And I mean, obviously one would be diversification, right? I think we all are just naturally wired to jump on the next shiny thing or whatever. And, whether it be real estate or whether it be growth stocks or tech stocks or whatever, just staying diversified is really important. And I think that gets, that phrase and that term, just gets replayed over and over. But I think that's one of the things that has kind of stuck with me through that process is just not getting overweighted in any one area. Always making sure, any type of, cash needs you have in the short term, is not invested in long-term investments that are, especially if they're illiquid. So as we just learned with, SVB, right? So, making sure that those shorter term needs are in more conservative, safer places, and just staying diversified and not getting too overweighted in any one asset class is probably what I learned the most from that. I also, grew up in a very frugal family. My father was a mechanic at a factory. My mom stayed home with me and my brother. We always lived well, but, just never had debt, never lived above our means. And I learned a lot of valuable lessons from that. And I think that was reiterated in my head through that 2008 process of, even if you can cash flow the payment, right? If you can't afford it, probably not good to buy it unless you're, it's good debt or you're investing money of some sort. So I think just making sure, cash is king, cash flow is good, living below your means, because there will be tough times. I think we would be kidding ourselves if we thought we would never, as humans, run into a tough time, and we will run into tough times again. And just being prepared and ready for that, I think, is from what I've seen, the people that have thrived the most in business or just in their financial life, they've always been able to weather that storm because they've prepared for it. And I think that's a big lesson that I really hold on to going forward and kind of moving through that time period.
Well, what I find, and I'm so glad we're talking a little bit about this, and I'm so glad you unpacked this a little bit, because when good times are going, everybody's successful, everybody's rock and rolling. And what's interesting to me, though, is we tend to get overconfidence, and that human psychology, right, our confirmation bias, etc., which is obviously sometimes produces in pride, arrogance, and then it obviously creates a fall, because then we start over leveraging. Then we start thinking, oh, we're a lot smarter than we actually are. We start doing stupid decisions. And what I've realized is wealth, it's one of those things, you can make a mountain with it, build an incredible mountain of wealth, but also you can build a huge hole as well. It just maximizes the direction wherever it may go. So Chris, I want to loop back on this, okay? You mentioned this has helped you during the 2008, 2009, helped you build the right boundaries and systems, and you mentioned just a few there. How do you approach that with your clients currently? And I know this is contextual depending upon obviously the risk tolerance, where they're coming from, are they W-2, are they business owners, but specifically talking directly to business owners, they come from where they've scaled a business, maybe they're mid-million dollar top line business, maybe an 8-figure business, which are most of our listeners, and they want to take some of those dividends and start, investing into other things, but they may not be familiar with those investing strategies. Like you said, you don't know what you don't know what questions, you don't know how to navigate it. So I'd love to talk about obviously certain safety boundaries that regardless of the ups or the downs, which will come and go in the market, I'd love for you to just talk a little bit about the structure and the methodology on your approach.
Yeah, I'm just going to go back to something you said about what we call behavioral finance, right? I mean, that's a term that you've probably heard in the industry, but it's even for me as a human being, like I have temptations with my own money, right? And we all have that. And I we work with some really wealthy, really smart people. I would tell you they, understand as much as I do when it comes to investing money or finance or whatever. But investments have become such a commodity. I mean, you can go on Schwab or Vanguard, and buy ETFs and funds and all that stuff. But, what you don't get with that, right, is the behavioral management and trying to avoid bad decisions in your financial life, which I think are the things that really put people behind. And if you look at the value of an advisor, one of the things we really try to get across to our clients is, you're not paying me to pick funds. Like that's the easy part. We've got all sorts of data and investment managers and so forth that can put really good portfolios together. I think you can go a lot of places and find that. But what the reason you work with an advisor is to be a sounding board, to help you make wise financial decisions, have discussions and think things through before you make moves, and try to avoid those pitfalls and mistakes. Because we've we've seen it. Like, I tell this to my clients who are entering retirement. Like, I've walked people through thousands of retirements already. So I've seen all the mistakes that they've made. I've seen the things that have made them really successful. So I'm trying to bring that experience to each and every client every day, as they move forward on their journey. And to them, it feels like they're the only ones that have ever retired in, the history of the United States. But that's not the case, right? We know there are commonalities behind successful retirements. And so, that's to back up on behavioral finance. I think that's really why people should, choose to work with a financial advisor, not because they pick the best stocks or funds, or they got this shiny, investment that can make someone a lot of money hypothetically. So that would be the first thing that I'd say, Christian. And then remind me the second thing you were asking about there.
No, that's really good to just footstop on that, because again, it is to realize that there's individual, just like yourself, Chris, that's able to run point guard for that, to be able to have a good balancing idea. Mm-hmm. The second question I was going to talk a little bit about is the infrastructure. I know that, again, this is contextual, but if you have like a situation where, hey, they were able to exit X amount of dollars out of their business, maybe they took maybe a 60% off their equity, partnering with a strategic partner, whatever it is, they took some cash out, cool, of their business, and now they're looking to deploy that capital. Like you mentioned, you can deploy that capital in this friend. They're going to create this business, and I'm going to invest into this fund or whatever. But the thing is you need to make sure that, okay, what is my investment thesis? What is the structure? How am I doing it? What's my risk tolerance? Things like that. So I'd love for you to unpack that kind of situation, hypothetical situation, and how you guys would run with it.
Yeah, excellent. Thank you for that. So especially in working with business owners, I think, sometimes they're caught off guard when I say this, but usually when I meet with someone for the first time, where they've kind of, either I've gotten introduced to them or they've contacted me or whatever because they want some help, the first thing I tell them is, most likely I'm not going to be able to get you anywhere close to the type of return you're getting in your business right now. If you look at the people that have really created wealth in America, it's been through mostly small to medium-sized businesses. And but what is also true about that is businesses are very illiquid, right? And so, one of the things that we work with our business owner clients on is liquidity more than looking just at rate of returns, right? So I always say covering all the what ifs, what if things don't go as you planned? What's plan B? Can I get you to a comfortable retirement without relying on some crazy valuation on your business when you exit? What if you want to exit and the economy isn't in a place, or you don't have the right buyer, or, what if? So, we're trying to cover all those things behind the scenes. Hopefully plan A works great and they sell their business for a ton of money and have a really awesome, retirement and have tons of fun, and hopefully give back to the communities they live in. But, that's not the way things always work out. So, we're talking a lot about liquidity. How do we minimize tax? I find a lot of people who aren't even taking advantage of 401k profit sharing type plans, especially with small businesses. So, we've run into a lot of small business people that have a lot of cash flow that, just putting away their, like this year, $22,500 plus their match, there are ways to go way above and beyond that, where we can start, really deferring $60,000 plus of pre-tax money, plus, looking at things like cash balance plans and other ways to defer tax down the road. And also, I get a lot of questions about Roth. Everyone at this point should have access to Roth in their 401k. So, should I put my money pre-tax or post-tax or whatever? So we deal with a lot of those questions. But I want to get them in a position where, if they don't get top dollar, or things change because of legislation or the markets or economy, or they lose a key person or whatever, how can we kind of create a moat around that business to still make it successful and accomplish the owner's goals, should things not work out quite like they hoped and thought that things would. So that's kind of what I see my role in working with business owners. I also would say I find a lot of the business owners we work with don't think far enough ahead when it comes to succession. Succession takes a long time. And I always say 5 years from the day you're like, that the owner says, I am ready to start handing this thing over. 5 years is a really good time frame. I find a lot of people that something happens and they get to this point and they're like, I want out of here in 12 months. And it's just like, you're not going to maximize your value and prepare the business for sale by doing it in that short of time frame. So the best time to start thinking about exit planning is when you're not ready to exit yet, right? And to start thinking through what that's like, identifying, do I have a key person that I can start to groom and mentor? Is there a competitor that might be interested in buying our business, or maybe there's children that might need to be mentored to come into the business. So that's from a time frame, something I find a lot with people is they're just not thinking far enough ahead into the future. And I think that's what we as advisors, as part of our job, is to get people thinking way ahead of where they're thinking is really important. And then the last thing I'll say is when it comes to equity, I think working backwards is really important. Determining when you want to have all of your equity sold, and then working backwards from there on kind of a timeline. So if you said, hey, I want to be out in 5 years, okay, well, just making this up, but let's structure something where it's 20% a year of equity you're going to sell over time, rather than just thinking about, nothing happens on one day, right? It's not like this big magic wand gets waved and I sell my business, I get all this money and life is good. It takes time to do it right. So.
No, and that's very good that you mentioned. There's quite a few points there that you mentioned that are very, very, I want to highlight that, very important. I want to talk a little bit about underutilized vehicles. And I'll just share with you real quick. My dad loved them tremendously. However, though, he worked at a private school. They had a small little, pension fund. Cool, wonderful. He's getting compensated. He's retired now. But then he owned a lot of some real estate. Not a lot, but enough to have a good, retirement and so forth. What I found interesting, though, is outside of that, he didn't invest into Roth IRA, into any of the stocks, into ETFs, anything like that, right? And what I found interesting is there is this, first I want to get your opinion on this. What are some misconceptions some business owners walk into? Because sometimes it's like, well, I can't control stocks, but I can control my business. So I'm going to take all my money and put it back into the business, or I'm going to put it under the mattress, or there's a lot of misconceptions. And I'd love to first, what do you notice in regards to misconceptions? And then, and I even see this, and I want to reiterate this with my audience. I even see this in the mid 8-figure business owners, right? They just shove everything back into the business, or they just take the dividends and they spend it, whatever it is. So I just want people to understand, this isn't just mid 7-figure business. This is, a small, family shop. It's 8-figure business owners as well. So I see this, human behavior, since we're talking about it quite often. So I want to just get your opinion on that, Chris. When you're having that dialogue with your clients, you see the writing on the wall. You're like, hey, let's do this. But sometimes for whatever reason, there may be a misconception. I'd love to just iron those misconceptions out for our audience.
Yeah, well, where my mind's going, and I've, I kind of made this assumption when I was younger in the business that wealthy people had it all figured out and everything taken care of. And what I found is that I've worked with some 9-figure families that, you come in and you're just little stuff. Like, why is that asset or that account not in your revocable trust, right? Why is that a probate asset, right? And just these little things that don't get caught. And a lot of times they'll have a brilliant attorney that puts all this really complex stuff together that frankly they don't fully understand, and it doesn't really get explained really well, and it just becomes kind of a hot mess, And so I have found, I'm probably going off script here a little bit from your question, but I've just found a lot of wealthy people as they get older almost just revert to simplify, consolidate more than, how can I, escape more tax or do this fancy planning strategy or whatever. Not to say that those aren't good or wise, but there's something really special about simplicity in your plan that I think a lot of people grow to appreciate as they grow wealth even more. So that would be the first thing is, even for really wealthy families, we find all sorts of little stuff that just gets overlooked and is not being paid attention to. So we kind of help navigate a lot of those things and consolidate as much as we can. I think you mentioned real estate. I love real estate. I own some real estate. It's kind of like the cool thing, right, to own real estate. I have a lot of physician clients that, especially the new ones, they want to own real estate. And I have some that do it really, really well, and I have some that get into it and don't really understand what it means to own real estate, and that is that it can be a lot of work, and you want to make sure you're taking the time to pay attention to the investment and what's going on. It's not something you just put money into and forget about, right? Like, you really need to make sure that this asset is performing the way you want it to perform. But I think real estate's a really good opportunity. I mean, look, the tax code by far benefits real estate investors more than any type of investment, especially when it comes to depreciation benefits and things of that nature. So I think those are great things. But again, it comes back to like building wealth. Let's try to build liquidity before we start buying all this illiquid stuff, right? Or let's try to get a foundation and some good habits built before we just dive into some multifamily housing complex that all my buddies are going in on, and I don't really know how it works or how the returns work or how to manage it or whatever. So, I mean, those are a couple of things that I would say, I find quite a bit and like to talk through with clients, hey, this is what this actually means if you do this, and this is what you need to be, the time you need to be spending to oversee this type of investment.
Do you find with some business owners that there are certain vehicles, and I'm just talking about not like external, like individual, like Roth IRA, traditional IRA, anything like that would be, individualistic, but I'm talking like a SEP plan or some sort of healthcare plan or something for their business that's actually underutilized. I'm noticing a lot of businesses, and this may be just like something I'm just seeing, and they're going a little bit more 1099, maybe because it is more remote. They don't give us so many more benefits, but now a lot of that relies back on that employee. But that gives the employer a little bit more flexibility. So I was just wondering, like, are you noticing some underutilized, vehicles that you guys have access to for business owners that they may not see the cost benefit of it?
Yeah, I mean, well, the first one, and it sounds so simple, but I find a lot of people that aren't maximizing the 401k space. For just a basic 401k profit sharing plan, especially if the characteristics of the business where you have owner who has a lot of income, you might have some employees who maybe aren't paid as much or are 1099 and you don't have employees. That's even better. I think that's a very underutilized vehicle. There's little things like the backdoor Roth IRA. I know that has been talked about a lot. I'm shocked they haven't closed that loophole yet, or Congress hasn't closed that. But they seem to be encouraging more and more Roth contributions. And one of the things that happened that I think a lot of people aren't familiar with is the passing of the Secure Act, the first Secure Act, when it comes to non-spouse inherited IRAs. Those now have to be distributed over 10 years from the date of death. And you know, what's interesting about that is if you just kind of look at normal mortality, our children, so let's say my case, my children are going to be in their prime earning years at their highest tax paying years. And now all of a sudden this IRA that, you know, let's say my wife and I never really needed because we were able to sell a business and live off that, gets passed on. And so then it becomes, okay, well, you know, maybe it does make more sense to do Roth if this is really legacy money versus money that I'm going to use during my lifetime, right? And so it's not all about how much tax I can save today. It's really also thinking about, you know, 30, 40 years in the future and multiple generations, and how that's going to affect multiple generations is something, you know, I really like to spend a lot of time on. So, you know, I think those are two just very simple things. They're not hard to do. We do them all the time. That, you know, business owners typically aren't taking an advantage of, especially if you're a solo person, 1099 person, or you've got a business where you've got, it's a small business with, you know, not a lot of employees.
I want to pivot a little bit toward alternative investing a little bit. You mentioned real estate, but outside of real estate, there's others that are like VC, that are private equity, that are natural gas, you know, opportunity zones. That's kind of, you know, dwindling a little bit. But I want to talk a little bit about that because that is more for high net worth accredited investors, quote unquote. And what's interesting, SEC guidelines, they have adjusted what is called accredited investors. So there's been a lot of flexibility with that. So people are getting access to it, which is really nice. These other opportunities outside of real estate. That's also an alternative investing, but you know, we already just mentioned that in regards to other advantageous tax you know, approaches. Yeah. But at what point do you think these individuals that are listening, you know, should they have X amount of dollars in principled fund, you know, in you know, ETFs, funds, mutual funds, things like that, you know, $4 or $5 million, and then start leveraging and looking at different, you know, alternative investing, private equity, venture capital. There's other, what I like to call sexy or exciting, you know, investing strategies. Yeah. What is your you know, methodology behind that?
Yeah, it's fun. I'm kind of smiling because I have a client who always says I manage his boring money. So, you know, meaning that the stocks, the bonds, et cetera. But he's a business owner and has a lot of different businesses and stuff, and that's the exciting stuff. But I'm his boring money, so I find that pretty funny. But anyway, I think it depends on the appetite for risk, and it also depends on your appetite for you know, I would say work that you want to do, right? You know, I have a job that I work 50, 60 hours a week already. Could I go invest in another business? Sure, but it'll probably fail because I really don't have the time to nurture that business. So I think one of the things would be just be realistic with yourself, and also think about other things in life, like how's this going to affect the time with my kids or my wife or my spouse or my whoever, right? Do I really have time to take this on? I might have the knowledge to do it, but is it something that I'm really going to be successful at would be the first thing. So that leads me down two different paths. Is this going to be something more active, a more active investment, or do I need to be looking at things that are more passive, like private equity funds, REIT funds, you know, things of that nature, where I'm just a silent investor, so to speak. So that would be the first thing I would decide, and I think that plays into real estate a lot, you know. Do I actually want to go buy real estate, manage it, or manage a property manager to do it for me? Do I want to be calculating returns and dealing with all that stuff? Or do I just want to get in as a private investor or a passive investor on a fund or something else that somebody else is going to do all that type of work, and they're going to take a cut for that, obviously. So I think deciding what type of investor you are is probably the first advice I would give. But to answer your question, I think it goes back to liquidity. You know, making sure that, because a lot of these private equity, private debt, types of investments are illiquid. And so just understanding you're tying capital up, and, understanding capital calls and things of this nature, can they do that? Do you have the funds to fund that? Is really important. So, I generally would not, for everybody's different, so I hate putting percentages around this, but, if you've got 15 to 20% of your wealth in things like private equity, private debt, things of that nature, if you're a high net worth person, I think that's pretty acceptable in my mind. And also, what's your preference for risk, and do you understand it? I have a lot of wealthy people that they just don't, as much as I can educate, they just don't understand it, and they'd rather stick to more traditional investments that they kind of understand that are liquid. So I think everybody is different in how you manage the alternative space. So does that answer your question?
It does. And I know it's a very contextual conversation because, like you just mentioned, it really has to align with that individual, their risk, their opportunity. What do they want to accomplish? How do they want to look at it? Are they want to be active? Are they want to be passive? Where are they at in their life? Do they just have an exit? Like, there's all sorts of things in conversations, dialogue. So I really appreciate you kind of unpacking that at a deeper level, and just the thought processes that you have with your clients, and what questions or how to think about this. Because I look at the private equity world, and I see an incredible internal rate of return on this, and it's outperforming a lot of the other alternative investing strategies. But if you, like you mentioned, you're known for saying this, and I want to reiterate this. And I think this is interesting. I want you to unpack this. Focus on the process, not on the outcome. And that's very unorthodox, because everybody's always like, I want $1 bajillion, and then reverse engineer, what do I get, right? And I want it tomorrow, right? Like you mentioned, everybody loves to, right now. So what do you mean by that? And I'd love for you to just unpack that for us.
Yeah, no, that's that. I actually stole that from a mentor of mine way back in the day, and it was a family I did some work for that is a very wealthy family in our community, and my friend was actually their kind of what do you want to say, private family office guy. And I had done some work, more product type work on their estate and some other insurance types of things that I'd done. And he actually said that to me, because I asked him, I just said, like, how do you deal with that size of wealth? This is probably 15 years ago. And that was something he said to me that stuck with me, that I've just used over and over. And really what it means is that outcomes are the function, outcomes are a function of a process or a decision that you made earlier on, right? So the decisions we make are really what lead to the outcome. So in a very simple contextual form, I just had this from a client, and we struggle with this all the time. He said, why haven't my investments this year performed like the S&P 500? And that's really hard for people to wrap their head around, because that's what they see on the news. That's what their friends are talking about, right? And so it just tells me maybe I haven't done a good enough job of educating, because that's just an outcome-based thing. What they forgot about was the process that we went through to determine that they're pretty risk-averse right now. We only have half their money in stocks, let alone the S&P 500. Right? And so I would not expect it, when the market goes up, for their portfolio to perform as well as the S&P 500. I know that wasn't my intent, because we talked about risk management, right? And so that's what I mean by, focus on the process, not the outcome. The process is the things that you can change and can control. The outcome just happens. You don't really control the outcome. And so I think that's really important in any, not just investing, but just in life in general, right? Is focusing on the process, not the actual return or benefit you receive. And that goes into business too, right? I think any of us who have been in business for a while can think back to the days of, another mentor of mine used to say, hopefully I can swear on this show, but you said, you got to eat the shit sandwich, right? And that's true. I mean, you just gotta stick it out and keep grinding, and it's about how quick you can get up, and it's about the process of day by day habits that lead to success that you have 10, 20, 30, 40 years into the future. And those are the things that change your trajectory of your life and your success. I don't know any of these people other than we have a few lottery winners as clients, but that's a whole nother story. But I don't know many people that have, just one day woke up and said, oh, I got 20 million or 50 million bucks and I didn't have to work for it and it wasn't hard, right? So that's a little bit long-winded to your question, but that's what I mean by focus on the process, not the outcome.
And I'm glad you share that, because you're exactly right. What I found interesting is I've had the opportunity to network with some very, very wealthy individuals. And during this, uncertain time, if you will, it is 2023, March 21st. And those that are high net worth and ultra high net worth, it's just another bump in the road. That's all they think, because they think so long term. They don't look on an annual basis their return. It's like, well, I know where I'm going and I know where it's pivoting and I know where you're skating to where the puck is going, right? That whole quote. So I love, and that's why I thought it was really cool, and I wanted to emphasize that for our podcast. Focus on the process, not on the outcome, because once you focus on what is going to produce the result, then it's like, well, then I don't have to worry about what's happening on a month-to-month basis, what's happening on an annual basis, oh my gosh, whatever, right? And it becomes an emotional train wreck. I want to talk a little bit about your strategy in regards to coming back on the M&A business side of things. You mentioned real quick the people need to, before they're thinking of exiting, they really need to have an exitable business, right? Building out the foundation so that when they're ready to go. However, though, let's be straightforward. Probably, I would imagine, I don't know what the statistic is, but I would imagine probably 70 to 80% they exit without really building out the foundation of what is necessary. And I'm curious, maybe they come to you when they're ready to sign the papers. Maybe they come to you, Chris, after they sign the papers, whatever it is. You probably have had certain circumstances.
Everything.
Yeah, I would imagine. So, Chris, I'm curious, first of all, for those that are thinking about selling their business in the near future, what are certain things that they should be aware of? And for those that have already sold their business and you've already dealt with this, well, let's stick with that first. Let's the first situation. Those that are looking to sell their business within the next few years, how should they be thinking about it? What are certain things that they should be, questions that they should be looking at that the buyer is going to look at, and looking at the KPIs, the metrics, the system, the assets, things like that.
Yeah, I could go two different ways, because one, we're doing a lot of M&A in our business with other advisors who are looking to exit, and so that's something we're really interested in. But I find the same things in my industry that I do in other industries, and a lot of times it comes down to this can happen. The owner has not reinvested in the business, and they've kind of leaned it out, and so they're also doing like a lot of different things and wearing a lot of different hats, and that leads to burnout. And so you kind of think of it as, okay, I can either go that direction and hopefully retire at an early age, maybe in my 50s, or I can reinvest in the business, mentor and develop people. I know control. I'm a control freak, just like every other business owner. But how do I let go of some things and allow other people to drive this business, to even higher valuations and a better business and a more successful transition than it is today. So what I find a lot of times is, we were just looking at another business that had 50, 60% profit margin, right? And on the surface you say, holy smokes, that's fantastic, right? But when you start peeling back the onion, it's a hot mess. Okay. And it's a hot mess because there's no team, the owners are stressed out. They just want to get out. It's like a fire sale, right? And when I see that as a buyer, I kind of go, this is a little more risk. And it hasn't really been nurtured real well. And so when I think of valuations, I start seeing that number they want, and I start in my mind bringing it down to thinking, okay, I'm going to have to hire this many people. I'm going to have to, do this, this, and this because they haven't. And so, I think getting into like profit margins and that stuff, we try to run in our firm about a 35 to 40% profit margin. And we know if we go above that is really where we might need to start looking at reinvesting in the business. And if we go below that, we might have invested too much in the business. So I think there's a happy medium and happy sweet spot there when it comes to profit margins and for the business owner to really be thinking about preparing the business for sale, like I mentioned earlier. So, those are, I don't, hopefully that answered your question, but those are things that I kind of think about and look for when I'm looking at business deals.
Well, I think it's so important, and I'm so glad you mentioned this, because on our podcast, we talk about, obviously, I've had some other individuals on, but we always talk about like what it would be for the perfect opportunity, for the perfect business. You have, over the last 5 years, you've had a 15, 20% year-over-year growth, and everything looks fine, everything looks fantastic. But the reality is, market changes. Things aren't actually always that way. And I love how you mentioned in regards to, let's be real, when you're looking at buying a business, you've had some years that are kind of negative, and you've had some years that are positive, but sometimes it's contextual depending upon the market. And like you mentioned, that was actually a red flag. It turned out to be a green flag. Like, wow, that was amazing, 50% margin, but then it turned into a red flag, and that also possibly an opportunity depending upon how you look at it. So, Chris, when you're talking to your business owners, right? Because I think this is a really good example. We went out of COVID. The restaurant biz just totally tanked. So if you're looking at buying and acquiring businesses from the restaurant biz, their KPIs are kind of messed up in the last 3 years, 4 years, right? So if you look at if you pull that data, it's like, but now we're also turning into another downturn, and we'll see what happens, what industries are going to be affected, whatever, right? But my point is business is messy, and sometimes it's not always that consistent year-over-year growth. And so when you're looking at the valuation, when you're looking to actually sell it, it's about really learning about what this data is telling you, the story that it's telling you. And I appreciate you explaining that. How else, when you are working with these business owners, how else do you interpret, whether it's on the buy side or the sell side, that are looking to, because I do know you guys are advising in that kind of facilitating that transaction. So to be able to say, okay, these are messy numbers, but how are we going to obviously posture it to make sure that we're going to get the most valuation, or vice versa? How are we going to obviously look at it to say, oh, wow, this is actually, compared to, industry-wide, this is actually a better, opportunity, better business, whatever. So I'd love for you to just unpack that, Chris.
Yeah, it's a really good question. I mean, first of all, businesses are people, right? And so anytime I'm doing a deal or talking to somebody who's doing a deal, I want to know the people behind that business, and I want to get to know them and who they are and what drives them, because that's really at the end of the day what we have, right? Is we have an organization on paper that's full of people, and so that helps me peel back that onion quite a bit, and I get to know kind of that heartbeat of the organization, and sometimes that's great, and sometimes it's not, right? And so you get to know kind of what you're walking into. Everybody's a good salesperson, right? So like I never look at a deal on paper and think like it's a slam dunk, right? Like there's something, if you see something so sweet, there's something else going on there. You just got to find it, right? And so, I really want to get in there, ask questions, I want to meet the front desk person, up to the, most senior person and talk to them about the business. And sometimes you get more information from them than you do anybody else. So, that would be my advice. Is it's not like deals are good or I mean, they can be good or bad, but like you just have to understand what you're dealing with, And then that helps you more appropriately find out what the value is of the business. And I agree with you, Christian. I think valuations are so funky right now in multiple industries. And so it's really hard just to put like a multiple on EBITDA or some other formula. You really have to figure out what you can do with that thing and what's that mean on as you acquire them. What's that do for you? Is it actually a good investment, or are you going to be overpaying and overworked and regretting that decision? Right? It's not always the best decision to buy or acquire another business. And I think sometimes we get wrapped up in, like you said, like M&A is kind of the cool word, and it sounds really fun and everything, but you can also make a lot of big mistakes doing M&A. So.
Yeah, I had a friend of mine, and he was looking at buying a business, and he, pulled the data, and he said in 2021 this business was negative 7%. In regards to the cash flow, but in the growth. However, though, the industry in that vertical, the whole industry was down negative 19%. So it's very interesting. If the story that they were figuring it out was like, well, it's actually very impressive, because now you're asking, contextually, how did they not go with the whole negative industry, and they actually kind of pivoted and bounced back upwards. So that was just impressive. So I always just find it interesting about the KPI. So sometimes you have to understand the story, like you mentioned, having these conversations, having these dialogues. So I appreciate you sharing that, definitely in the M&A, because it's a messy business, like you mentioned. It is a messy business, but if you know what you're looking for. Now, Chris, I really appreciate you being on here, man. Just talking about, your wisdom, your knowledge in the uncertainty, but also the methodologies, the principles that you use that are timeless. Doesn't matter if it's an up industry, doesn't matter up markets, it doesn't matter if it's down market. You can leverage these methodologies and principles and this wisdom to deploy and stay, like you mentioned, in regards to focus on the process, not on the outcome. For those that want to reach out to you, that have some questions, that are looking to maybe sell their business or have those conversations, maybe they've sold their business, or maybe they're they want to they were very impressed with what you had to say. How do they reach out to you and be part of what you got going on, my man?
Yeah, no, thanks for asking that. I appreciate it. So my email is cgraw, that's CGRAW at carsonwealth.com. So Carson is spelled CARSON, wealth.com, and you can also visit our website at carsonwealth.com. And we've got a number of partners throughout the country. I'm located in Cedar Rapids, Iowa, so heartland of the Midwest, center of the universe, and so we love it here. And but that's how you can get a hold of me. So appreciate you having me on too. This has been really enjoyable, and I've enjoyed listening to some of the other podcasts that you've shared, Christian. And thanks for the good work you're doing with your work. So.
Awesome. And I really appreciate you being on here big time, Chris. Guys, for those that want to reach out to Chris Graw, that is, I put his email. I appreciate Chris making yourself so available. I put his email down there, I put his LinkedIn, and put the website as well, so you guys can get access to it. Carson Wealth, they have a lot of good content out there, so I would recommend just consuming that. Really give an understanding. One of the biggest things, you don't know what you don't know, so you work with someone like Chris, be able to bounce these ideas off, so you can navigate your wealth and create what we all want to do, is generational wealth, and creating that empire for the second and third and fourth generation. Chris, again, I really appreciate you being on here. Guys, that is my friend, the one and only Chris Graw at Carson Wealth, certified financial planner. That is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.